So good morning, friends. Today we are going to understand the how to model the irrational behavior of the investors in the stock market. There are many names of noise trading, like irrational behavior, noise traders, herd behavior. So there are many synonyms of noise trading. And why this topic is important? Because uh, most of the stocks, they are suffering from this problem, and rational investors or the smart investors take the benefit of noise trading. Noise trading have one advantage, that they provide liquidity to the market. Market is moving a lot. And the disadvantage is sometimes the prices are misprices. So they take away the prices from their fundamental values, and because of which the informed investors make money. So from this aspect, there is a world famous model of noise trading. There are many models, in fact, but we find out three or four models of identifying the noise trading, so that we are going to discuss today. So who are the noise traders? There are some definitions of noise traders. Number one, those investors who make decisions, investment decisions, because of the gossips, because of the rumors, because of their incomplete knowledge, and they don't, their investment decisions are not backed by a proper research, the fundamental analysis, technical analysis. So without doing any analysis, just from with the help of gossip or suggestion of somebody else in the TV or in the newspaper, or without any reason, you are investing. This investment is known as noise trading. So these are the definitions of noise traders, who make decisions regarding buy and sell trades in security market without the support of professional advice or fundamental or technical analysis. A noise trader is a person who trade based on gossips or rumors rather than fundamental or technical analysis of the stock. And these traders are also known as irrational traders. So they make bets, means they take investment decisions on the basis of insufficient and erroneous data. And basically, if we think, even I myself is also a noise trader, because we uh, we are basically biased traders. We invest in the stocks on the basis of our gut feeling, and the stock which is having good image in the market. We are not doing any analysis. So there's a lot of noise traders in the market, and these noise traders are providing the liquidity, also having some disadvantage also. So there is a theory regarding the noise trading. The theory is efficient market hypothesis. So efficient market hypothesis say that there is a theory in finance. The efficient market hypothesis say that the markets are efficient. Market markets are efficient means the prices are fair. Whatever prices of the stocks at any time, they are representing the fair price. Number two, whatever information comes in the market, it is accurately absorbed by the traders. So there are two type of efficiencies in the market. One is the price efficiency, and second is the information efficiency. So price efficiency means the stock prices are fair, prices are efficient. So at whatever be the price of the stock at any time, it is fair, right price. The second is information efficiency, means all available information are absorbed by the market. On the other side, there are behavioral investments. So behavioral finance, people in behavioral finance say they believe that market is not efficient. Market is guided by the emotions of greed and fear. So they say that market is not efficient, prices are not fair, the information, all information are not absorbed properly. So there is a lot of irrational trading going on in the market. So there are two thoughts. One is the efficient market thought, and second is the behavioral finance thought. So the researchers in the behavioral finance, they believe that the investment decisions are not rational, they are influenced by the emotions. So noise traders are basically, they are making the market inefficient. Smart traders making the market efficient. So if we identify the noise traders in the market and we prove that the noise trading is significant, it means we are proving that market is not efficient. And if market is not efficient, it means the smart investors can make money. The informed investors can make super normal profits. So some people are making super normal profits, some people are losing their money because of this inefficiency. So this noise traders influence the market through a risk which is called noise trader risk. So we are going to develop a model for identifying this noise trader risk today. So noise traders are not informing or information. So these are the some conclusions of some people, researchers. So literature developed a number of models to quantify the impact of noise traders and noise trading risk. So these are some of the models, some of the researchers who developed the model for noise traders. Now we are going to develop the model number 1. This model is known as information adjusted noise model, IANM. Information adjusted noise model. So first model which we are going to discuss now and which is the most important model in identifying the noise in the market is IANM. And it's very simple. So you know that the oldest model of explaining the portfolio return is CAPM, CAPM. So capital asset pricing says that the asset price can be influenced by the model with the help of relating it with market premium. Market premium is calculated by the return of the market minus risk-free rate. So those who are in finance, they understand these terms. Risk premium is the difference between market return minus risk-free return. So on the basis of capital asset pricing model, there's a new model. This model is known as behavioral asset pricing model. So efficient market believes on CAPM and behavioral finance believes on BAPM, behavioral asset pricing model. Now there is a difference in CAPM and BAPM. So what is the difference? We are going to understand. So this new model say that with the help of BAPM, we can calculate a beta which is known as behavioral beta. In CAPM, we also calculate a beta which is known as the measure of systematic risk. So in CAPM, we calculate the beta. Beta is known as measure of systematic risk. In BAPM, we are also calculating the beta, and this is called behavioral beta. And CAPM beta is normally a measure of systematic risk, and the behavioral beta is consisting of systematic risk plus noise trader risk. So CAPM beta is equal to systematic risk, and behavioral beta is equal to systematic risk plus noise trading risk. Now, if you take the difference of both, if you take the difference of behavioral beta minus systematic beta, the difference of the beta is known as noise trading risk. So the difference between two is the measure of noise trading risk. BAPM is similar to CAPM, but there are two differences between CAPM and BAPM that I'm going to discuss. Okay. Now, the model was developed by Ramaiah and Davidson. They say that if we calculate the difference between the two beta, CAPM beta and BAPM beta, so this beta is representing the noise trader risk, and it can be modeled to identify the impact of noise traders on the market. So this model is called IANM, information adjusted noise model. So by definition, I'm showing you the model. So the first equation, if you check the first equation is representing the CAPM model. So RIT is the return of the portfolio or the stock minus risk-free rate equal to alpha plus beta I. See, beta I is CAPM beta. and this is representing the risk premium. So the return provided by the market over and above the risk-free rate. So if we apply this equation, we can calculate the CAPM beta. Now we are removing the market return by RMTB. In this case, the RM is basically the market index. For example, in India, we can take the Nifty. Return provided by the Nifty is representing the RM. Now this index is replaced by another index. This index is called Dragon Index. RMB. It is Behavioral Sentiment Index. So we are taking two index in two different equations. One is Nifty, and this is called most index for most liquid stocks. So in India, we are having an index called Nifty Liquid Index. It is a index representing the most liquid stocks. How many stocks? 15 stocks. So it is an index of most 15 liquid stocks. So first of all, I am replacing the market index by the liquid index, by the Dragon Index. You can say it is a Dragon Index. So the index consisting of most liquid stocks. And when you run this equation, the beta is different. Why beta is different? Because the reaction of the investors to the most liquid stocks is different. So there are some stocks in the index which are most liquid, and most of the noise traders are dealing with them. So more volume, involvement of more noise traders. So by replacing the market index from Nifty to liquid index, the beta will change. So this new beta, if we calculate this new beta is known as the behavioral beta. Actually, I make this mistake. It is not CAPM beta. Beta C is CAPM beta. It is behavioral beta. So this is behavioral beta. So we calculate two beta from the two equations. One is the CAPM beta and second is the behavioral beta. So we can take the difference between the BAPM and CAPM. Difference between BAPM and CAPM. This difference is coming from the noise traders in sentiment index. So we assume that the difference of the beta is known as noise trading risk. Sentiment index consists of top 10 or top 15 most liquid stocks on the stock exchange to construct the behavioral index. And such as index is known as Dragon Index. So we use the term Dragon Index to represent the behavioral beta. So I hope we are having clarity up to here. So we calculate two beta by two market indices, the Nifty as well as the liquid index. From the market equation, first equation, we are getting the CAPM beta, and from the liquid index, we are getting the BAPM beta. Now we can take the difference. This difference is known as behavioral error. So equation 1 and 2 are estimated on the daily basis using a window of previous 250 days. You know that we are having a formula for calculating the beta, that is covariance between the return of the stock market divided by the variance of the market. So this is the formula for calculating the beta. When we take the difference between the two beta, CAPM beta, BAPM beta, this difference is known as the behavioral error. Behavioral error. So the difference between the two beta is known as behavioral error, represented as this. So this difference can be used to determine whether or not the market is inefficient and a proxy of noise trader risk. And this change in beta, behavioral error, is due to many events. Sometimes the company changes the portfolio, the capital structure. Sometimes the news comes about the company. Sometimes the market is influenced by some major news or information, and noise trading. So the difference between the beta is basically coming from the unknown factors. Simple. And the unknown factors is not defined. We cannot define that why the market is moving up or moving down. But one thing which we know is that today a lot of investors take the position in the stock in positive side or negative side. Because of this, the beta is increases or beta is decreases. And this beta is away from the normal beta. And this difference is representing the noise trading behavior. So behavioral error is what? It is representing the noise trading risk. Now I think we are having clarity on that. So the further, we will use this behavioral error to model the equation. First of all, we control for the information error. Now we assume that suppose a bad news comes into the market on a particular day. On that day, the investors take their position according to their psychology. If they feel that after this news, the stock price may go up, so they can start buying the stock. If they feel that after this news, the stock may decline in the future, then they start selling the stock. So we believe that the investors react on the news or some information or some herding behavior. Herding behavior means if we feel that market is down today, so we can start selling. And if we feel that market is moving up, so we can start buying. So this is the reaction of the investor towards the herd behavior. Herd behavior means whatever overall market is behaving. So this kind of trading comes under the noise trading behavior. So what we are doing here to how to make the proxy of the news. So this information error is representing the proxy of the news. And there are many models, that which from where we can make the proxy of the news. So we can take the ARIMA model and save the errors of the ARIMA model. And the errors, that the errors of the ARIMA is representing the shocks. In ARIMA model, we call these shocks as moving average, MA, MA1, MA2. So we can take the proxy of this information error by saving the residuals of the ARIMA. And now we divided the errors into two categories. So we take the errors into two categories. One is the strong news, and the second is the weak news. So strong news and weak news. So we are not looking here whether the news is positive or negative. Simply whether the news is significant, whether the news is not significant. So how I categorize them? Let's see. The IE. Now we are talking about IE. So IE is firm specific information, new information release. Information arrival can be interpreted differently as good or bad news by different set of investors. If the market is going on, the value traders can start looking for the valued stocks and buy them. And the momentum traders can start selling the stock. Right. So every news can be perceived by two different ways. However, IE does not distinguish between good news and bad news. Simply taking the form of a dummy variable, taking the value of 1 on information arrival and 0 otherwise. So when the news is coming, it is represented as 1. When the news is not significant, it is considered as 0. So there are two types of news, significant news and non-significant news, simply. So there are two types of news, significant news and non-significant news. So this can be estimated by taking the dummy, converting the error term from ARIMA into dummy variable. I will show you how we can do that. And in this equation, this alpha is representing the noise trading behavior, and this gamma is representing the smart trading behavior. So there are two components from this equation we can draw. The alpha is assumed to be, what is alpha? If there is no news, how the investors are reacting to contributing to the change in the beta. So if this change in beta is coming from the alpha, alpha means intercept. Intercept is defined as when y is x is 0, what is the value of change y? How much y value is there when IE is 0? So if there is no information and alpha is significant, then we assume that alpha is a measure of noise traders. So in this equation, this alpha is the reaction of the noise traders, and gamma, anybody who is reacting to the information, is called smart investors. So gamma is considered as the reaction of the smart investors. So in this equation, there are two coefficients, alpha and gamma. Alpha is representing noise trading behavior, Gamma is trading the information based trading behavior. So that is called smart investment. So there are two type of investors we assume: informed investors and uninformed investors. So alpha is representing the uninformed investors or noise traders, and gamma is representing the smart investors or informed investors. So I hope you understand what is alpha and gamma, because according to the alpha and gamma, we study different cases. So these different cases are, let me explain. So according to the efficient market hypothesis, noise traders should be quickly eliminated from the market as a result of arbitrage. So what it means? It means that if because of noise traders, stock prices is moving away from their fundamental, then smart investors will take the opposite position and come back or bring back the price to the original level or fundamental value. If the market is efficient, it means the change in alpha is equal to the change in gamma. So for EMH to be valid, the change in the behavioral error must be equal to zero. Because ideally, if somebody take the price away, it is responsibility of informed investor to bring the price back. So by studying the alpha and beta, we can identify whether the change in beta is equal to zero. And if change in beta is not equal to zero, it means the market is inefficient. So we identify two things: whether the change in beta is zero or change in beta error is significant. So now from this equation, sigma BE is equal to alpha plus ET. So we assume that information traders enter the market only when information is released. Informed investors, they react to the market only when information is coming. So this equation reduces to this. So alpha can be represented as the behavior of the noise investors even when there is no news in the market, and how much it is contributing to behavioral error. So this is purely noise trading behavior. So there are three possibilities. Whenever information comes, there are three possibilities. Whenever information comes, there are three possibilities. The smart investors may have no reaction, may have opposing noise traders, or joining noise traders. So smart investors can react in three ways. On those days when information is there, they can be silent. It means gamma is zero. If gamma is zero, it means smart traders is not correcting the market. Simple. And if gamma is less than zero, it means they are correcting the market. So this is called opposing the noise traders. And sometimes if we found that gamma is positive, it means they are joining the noise traders. So it means they are also doing the momentum trading. They are not doing the informed trading. So there are three possible cases in the market: no reaction, opposing noise traders, and joining noise traders. In second case, the market is efficient. In other two cases, we believe that market is also not efficient. Okay. Now one more thing. Now we compare the magnitude of alpha and gamma. By comparing the magnitude of alpha and gamma, we can also identify that what is the nature of response from the smart investors. So there are three possible response of a smart investors. One is the underreaction and overreaction and information IPE. So there are three possibilities. Either they do the underreaction, they do the overreaction, or third is IPE. There are three possibilities. And these three possibilities are basically comparing by alpha with beta, with gamma. So just to recall, alpha is representing the noise traders and gamma is representing the behavior of the smart investors. So if we compare them, we can conclude that three possibilities. Sometimes the smart investors can underreact. Sometimes the smart investors can overreact. And the third possibility is known as IPE. Okay, so let me explain this concept. So and in short, there are six possibilities. Let me compare one by one. When alpha is greater than zero and gamma is less than zero, so this is called the underreaction, but it is positive underreaction. So positive underreaction. Similarly, U plus means underreaction plus positive underreaction. So smart investors are correcting the market, but underreact, but their reaction is less than the noise status. Second condition is that when alpha is less than 0 and gamma is more than 0, so they are opposite, they are behaving opposite. So it is called underreaction but negative underreaction. Then third case is if alpha is less than 0 and gamma is more than 0, and the u is the total, u is the sum of alpha plus gamma, is greater than 0. So this is called positive overreaction and positive underreaction. So these are the possibilities when you can also identify whether the reaction, which type of reaction is coming from the smart investors in the market. So we can identify whatever be the case. And just to see this, when noise trading makes an error, it means alpha is greater than 0. Alpha is measure of noise trading risk. When noise traders makes an error and information traders oppose them but fail to ensure them image holds. So this is called information traders underreact to information arrival. This situation is called positive underreaction. So similarly, when alpha is less than 0 and information traders underreact, this is underreaction negative. So we divide all the cases into 6 cases, and these 6 cases we can identify on the basis of 3 parameters: alpha, gamma, and mu. Now, once we identify whether the market is underreacting, noise traders is overreacting, then we can run one equation. So in this case, we are assuming that the return of the stock of the portfolio is influenced by the previous behavioral error. So you can see that we are taking the mu t minus 1. So now we want to check whether the behavioral error, change in the behavioral error, is causing the future return or not. So this is known as the impact of noise trading behavior on the market return. Similarly, you can also calculate the impact of this behavior on the market volatility. The same way, we can also check the impact of noise trading behavior on the volatility. Same way, we can check the impact of previous day, leg 1. Previous day noise trading behavior on the return. So assuming that behavioral error is a proxy of noise trading activities and U as a more accurate measure of noise trader risk, by linking any of these two measures with asset return, we can determine if a noise trading is a rewarding exercise or not. The following model is estimated for this purpose. The dependent variable is the return on a stock, and the independent variable is the lagged value of change in non-trader risk. So we can also find out how the noise trading behavior can have an impact on the return or the volatility. Further, we have 2 more approaches to justify the noise trading behavior. So as we studied Kalman filter approach yesterday, so we can identify the 2 series. One is the natural series and original series, or second is the filtered series. We take the difference of the 2 series, and as we calculate the difference between actual series returns and the returns on the filter series, and test the hypothesis when the difference of the returns of the actual series and the filtered series is 0 or not. If it is 0, it means the noise trading behavior is not significant. And if it is not equal to 0, then it means noise trading behavior is significant. So you can also identify the presence of noise trading behavior by using the Kalman filter approach. The another approach is which is applied in the literature is whether the beta, so difference in the beta, so that we calculate the behavioral error, whether that behavioral error is significant or not. So first of all, we can also check whether the difference between the CAPM beta and the Dragon Index beta, or we can call it BAPM beta, whether that beta is significant or insignificant. So there are 3 models which we find to identify the noise trading behavior